Hey, everybody, it's Nicole Benjamin, your host here at Seeking Alpha, to bring to you another episode of the Weekly Grade with Stephen Cress. And we're going to be bringing to you market insights in minutes. Joining us today is Stephen Cress himself, VP of Quantitative Strategy here at Seeking Alpha. He's the wonderful person behind a lot of the amazing products you see on site, our Alpha Picks portfolio, our Pro Quant portfolio, and our latest, the Quant Growth and Income portfolio. So if any of those products might be of interest to you, take a look and also follow Steve on our website. Steve, thank you so much for joining us today.
Thank you so much for having me. Great day to be here and good timing in regards to the stock we're speaking about.
Yay! Absolutely. Well, let's jump into it. Lumentum Holdings. So I see here Lumentum is a top tier strong buy rating, a flawless A+ growth. So how does the company still maintain this attractive valuation for investors?
Well, they keep beating earnings expectations and revenue expectations. That's why it's so timely. The company reported today, which I believe makes it its 13th consecutive EPS beat. And they continue to beat expectations. This company is in the right place at the right time. They manufacture and sell optical and photonic products, which is the sweet spot for AI and data centers. It basically helps information move much faster. As you can imagine, if you are familiar with technology at all, optics and photonics helps enable much faster communication than, say, a traditional like copper fiber. So this is their sweet spot. And 13 quarters in a row, they've been beating expectations. In terms of how the stock looks at a quant basis, when you look at the factor grades on the right-hand side, you'll see valuation, growth, profitability, momentum. Those grades are actually sector relative. So when you look at the valuation grade of A, it means that it is much cheaper than the rest of the sector. And when you look at the growth of A, it means that the growth rate for the company is much faster than the sector. And I think what's really interesting is the stock today definitely responded well to their earnings beat. It's up about 15%. But if we look at the stock over the last year, it's up 686. If we look at the stock over the last 6 months, it's up 61%. But what really speaks to me is despite that rise, clearly we have not missed out because the valuation grade, if you look at this card, you can see it was a C 6 months ago. So the stock was actually more expensive 6 months ago than it is today. It's actually inexpensive now compared to where it was 6 months ago. And it's far more inexpensive compared to the sector. The growth rate continues to be really strong, as well as the profitability. It's in line with the sector. I think kind of what speaks to me is analysts are most likely going to have to revise their numbers up. We see that revision grade is a C+ versus an A- 6 months ago. So analysts, a few of them have actually reduced their earnings estimate, and that's why that grade was a C+. But with the company beating both top and bottom line today, I'm sure there's going to be a number of analysts taking their earnings estimates up. So companies had tremendous growth. The revenue is over the last 4 quarters has jumped 109%. The forward revenue growth rate is 61% versus the sector at 12.5%. And the leveraged free cash flow growth year over year has been 878%. So really looks terrific.
All right. Well, I also want to talk about this, beat down with the AI rotation. I'm seeing here that hyperscalers have nearly tripled their AI capex to $448 billion and plan to double that global data center capacity by 2030. So with that in mind, with tech stocks experiencing this recent volatility, how does the long-term infrastructure boom create this pricing power for essential suppliers like Lumentum?
Well, I'll tell you what, the people who sold off the stocks, they're probably not going to be happy that they sold it because it looks like the company is really on the way back up. As I mentioned today, it's up 14.5%. It did take a pretty big fall. So speaking to that dip, the stock had been in May. It was like, I guess, at the end of May, we were looking at the stock at about $1,000 per share. And then it had dropped down to July 30th, which was just 2 weeks ago. It was at 602, but the stock is already making a major move back up. It's climbed from 602 to $939. So not all the stocks have climbed back that are part of that AI dip based on the rotation that's occurred, but many of the stocks are now actually starting to fight their way back. as they've been reporting their numbers. So this rotation has occurred. It occurred. There was fear in the market. There was anxiety. A combination of that came from fear of interest rates going higher, inflation being stickier, a new Fed chair. We also have a seasonality impact with the November elections. And going back to 1925, during midterm elections, the markets have pulled back. But notably, after those midterm elections, markets have always been up. So I believe that, a lot of this AI rotation was occurring because of those fears. It looks like now, though, with companies reporting and beating expectations, they are definitely firing up like rockets off of their lows that they've had recently, which were really just like 2 weeks ago.
All right. I want to jump on over to our amazing Alpha Pix portfolio. It continues to beat the S&P 500, up over 364% since inception. So how do the quantitative rules identify high-speed tech winners like Lumentum before the broader market prices in their full growth potential?
Yeah, absolutely. So with Alpha Picks, as we do in our quant system, we look for companies that are collectively strong on value, growth, profitability, positive analyst revisions, and momentum. So we really look for companies with those investment characteristics. We're not trying to focus on any sector per se, but typically what happens is we'll find a period in time, such as we are now. There are a lot of IT stocks, in particular AI stocks, that have had superior growth. And what we do with our model is we try and identify the ones that offer good value as well. So we really sort of have a GARP approach, which is growth at a reasonable price. And we target that. And if the sector falls into the place, sometimes there'll be a clustering effect. So we do have quite a few IT stocks in there. And that's because the growth is so superior. But we're not looking at the most expensive IT companies. We're looking at ones that do offer good value as well.
Well, I think we'll leave it there. Thank you so much, Steve, for joining us today. And for everybody that's listening in, go ahead, look into Lumentum, follow Steve on his profile, and read the article. See if there might be some additional information that might be helpful for your portfolio. Now, just for some housekeeping, past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. And we'll see you here next time. Thank you so much.